All right, hi everyone. In this lesson, we're going to go over the statements, how to find if a fantastic business is safe, stable, and stronger than you thought it was in its current statements. So, usually in a financial statement, you have the balance sheets, income statements, cash flow statement, and with the balance sheet, you will get the equity, which will be the shareholders' equity. So, let's get right down into it. Now, a basic area to analyze at first when you look at the financial statements is a few areas. One of them is the income statement. So the income statement is a statement within the financial statements. It's a statement that shows you all the revenue, sales, and the cost of making the sale, including cost of goods, amortization expenses, SG&A expenses, R&D, and tax reduction and deduction expenses, which net in total after this, including all cost after revenue intake, makes net income. All expenses required to make the existing product, right, and run the existing product to the user or client. Cost of producing the item, and at the end selling it, which is similar to ramp up, only that ramp up stands for producing ahead of time of the item for anticipated demand. This happens often in business. A traditional definition is the income statement focuses on the revenue, expenses, gains, and losses of a company during a particular period. The income statement focuses on four key items: revenue, expenses, gains, and losses. It does not differentiate between cash and non-cash receipts, which are sales in cash versus sales on credit, or cash versus non-cash payments or disbursements, as in purchases in cash versus cash purchases on credit. It starts with the details of sales and then works down to compute net income and eventually earnings per share. Essentially, it gives an account of how the net revenue realized by the company gets transformed onto net earnings from profits or losses. So that's for the income statement. You're going to see the sales and revenue there. You're going to see afterward what are the expenses that come in afterwards, the revenues and sales, in order to operate the business, in order to pay the cost of making the product to sell. And then what are the interests and tax payments that come after that. From net in total, if you calculate all this, you're going to get the net income that was shown in the income statement. Now for the balance sheet. The balance sheet is the company's assets and liabilities. If you calculate the assets and liabilities, that should give you the equity, which are the shareholders' equity. And you'll have this all in the balance sheet. This is where you'll find their cash, investment, account receivables, inventory, property, plant and equipment, intangible assets. And then on the liability section, you will find the short-term and long-term debt. Also, for some of you who don't know this, if you don't know what an account receivable is, an account receivable is the money a company's customers owe for goods or services that have received but not yet paid. So that means if a person purchases your product, right, for a subscription, and let's say that they're paying on an interval, they haven't made the full payment, right, or you're going to charge them for the next payment until a month ahead, but they're not being charged immediately, even when getting the service, that's called an account receivable. Those are very common in subscription services and products that offer subscriptions, anything that has an interest sort of payment towards a product or service you're using. And this is extremely common for credit companies, because as you utilize credit, you're not going to pay the full amount until a certain amount. So credit companies tend to have a lot of account receivables, including some portions with banks, but most of all credit companies. And for this area, because I forgot to mention, amortization. An amortization expense is the write-off of an intangible asset over its expected period of use, right? So if it's fully been used and it's not going to, let's say it gets removed out of the statements because it's not producing anything, or maybe it got sold, or maybe it went bankrupt, that sort of item, or it's not selling as effectively, or is losing money, it's actually the write-off of the intangible asset. It's the opposite. It shows, because that's what a write-off is. It shows the amount of write-offs that you have over an intangible assets in total. I just wanted to clarify that. On the liability section, back to the balance sheets, you will find short-term and long-term debt, account payables, and capital leases, obligations, and deferred taxes. Also, account payables is a short-term debt and a liability on a balance sheet where a business owes money to its vendors or suppliers that have provided the business with goods or services on credit. So it's basically a loan to utilize the product that they're using, right? And that account payable is the interest that they have to pay, or liability that they have to pay towards that provider or that supplier. That's providing them the goods or services with on credit. So it's essentially a loan. It's essentially a leveraging system. That's why it's in the liabilities. It's the interest payments they have to use for the items that they're borrowing or that they're leveraging to make their products and services based on credit. A lot of companies do that too. Then after this, you will get the common equity, right? From the assets minus the liabilities, which is their liquid cash. This liquid cash can be given to investors or the stock to retain earnings or buy more common stock with this equity as a mean of cash. Also, this is referred to as well as the liquidation value of a company. What it signifies is that if a company went bankrupt and it would sell all their assets and liabilities, whatever money that's left out of that will be paid back to the investors. So if the company has $352 billion in total assets and $302 billion in total liabilities, net outstanding out of that is $50 billion of common equity, which will be paid to investors. So if the company has 500 million shares outstanding, each of those 500 million shares outstanding publicly will have 500 million investors handed out to them in full amounts of proportion of 50. I actually forgot there's actually a typo. Let me fix that. All right. So there's going to be $50 billion of common equity that will be paid to investors. So if the company has 500 million shares outstanding, each of those 500 million investors will be handing out the full amount to the proportion of $50 billion divided by 500 million shares equals $100 per share of investor. So if you had 10 shares and the company went bankrupt, you would be paid $1,000 from the money left out from the liquidation, right? Keep in mind though that if a company is so valuable, don't regard this as a sole intrinsic value because it's almost impossible for an amazing company to go bankrupt. So this part valuation is added to the projector outlook of how much this equity or net income or cash flow will increase per year and decades. This will make the intrinsic value, of course, worth more for that time because the company will produce more and more as time keeps passing on. All right, so now for the cash flow statement. A cash flow statement it tracks all the cash and cash equivalents, which are cash and investments that come in and out of the business. The cash flow statement measures how well a company manages its cash position, meaning how well the company generates cash to pay its debt obligations and fund its operating expenses. The cash flow statement makes up operating activities, investing activities, and financing activities. In operating activities, it shows net income before extraordinaries, which is another word for expenses. It shows depreciation, depletion and amortization, deferred taxes and investment tax credit and other funds from operations, which is the operating income. And that's the income before actually, just so you can know, operating income is the income that comes before interest or taxes. It shows receivables, account payables, and other assets divided by liabilities, which net in total gives you the net operating cash flow from the operating activities section on the cash flow statement. And that net operating cash flow is a very important item that we'll talk about in the upcoming slides. For the investing activity, which is another section in the cash flow statement, that shows you the expenses it has to pay for the capital it has and the cost of investment in capital used for managing products and services. The cash flow statement is essentially how the business uses its capital to invest, to pay, to lease, and to leverage, like in loans, for example, to use capital payments activities or pay interest for dividends, repurchasing common stock, an issuance and reduction of debt from the stock for the capital used. Also, in the cash flow statements, it shows the capital it has to use to run, pay, and invest in things or build things with the capital it has afterwards the income statement. Also, they use this capital to buy other businesses as acquisitions, which will also show this in its cash flow statements to find the acquisitions. Anyways, back to investing activities. This shows you to the capital expenditures, net assets from acquisitions, purchase and sales of investments. This net in total will give you the net investing cash flow. Now for another section in the cash flow segment, so just so I can repeat, that investing segment, remember, that's just the payment of the capital that they're using. That's the payments that they have to use with the capital outstanding and the capital utilization that they use in their business. And that would be, capital expenditures, the assets from their acquisitions, purchase, sale of investments, that sort of thing. Now, for the other section of cash flow statement, which is the financing activity, this financing activity is going to show you the total cash dividends paid, which are common dividends and preferred dividends paid out. It also shows the change in capital stock. And change in capital stocks is referring to repurchases of common stock or preferred stock, proceeds from stock options, and other proceeds from sale of the stock. It shows total net debt issuance reduction, like change in current debts, a change in long-term debt within stock, issuance of long-term debt, and reduction in long-term debt. And it shows other funds and uses. Net in total after this, you're going to be given the net financing cash flow if you add it all up. Now, the most important thing in this section of the financing activity is the free cash flow, because this will show you the cash left over after paying its operating expenses and capital expenditures. This signifies how efficient is the company generating cash from what it currently has in the business for what it's using right now, to maintain for what they're running and structuring the business in terms of capital for their general innovation or projects they want to do. The more they have this, the better it shows the business isn't needed to require big amounts of capital expenditures or big amounts of operating cost to continue selling as effectively as they do with their current products. So this gives a lot of funds for the company net in total afterwards to freely use it, and won't affect their current business a bit, to which they can get involved in a business entirely different and build upon that product with that free cash flow, right? If they really wanted to innovate somewhere else. What mostly likely tends to happen with this free cash flow is that they just stick with what they're excelling at in their products and evolve that product and make it better for the demand and the anticipated demand that isn't happening yet, by getting their product more innovative and maintain a good margin in which it shows you the limits they can invest in currently for this sort of circulation to keep the company running on what they're good at and the funds that they can innovate. But with a big margin of cash left after this, it shows you a very cost-effective business, essentially, if they have a lot of free cash flow. They can also make use of this free cash flow as cash for dividends or share buybacks or anything else that can increase the interest of the shareholder inside the company. That tends to be pretty common, most of all with companies. You don't want, now, what I will tell you is this: you don't want a very effective business that's not making as much money to be so focusing on incentivizing interest for the shareholder, because that's not the focus the company should be looking at. The focus is where it should utilize its capital to reimburse back to the business to increase its product value. But if it's not doing that, their product value isn't selling as much, it's actually sort of a red flag when an unprofitable company is putting too much of its interest into the shareholder for the company if there's not much worth in that interest to even start with. This is essentially, the return the company is making out of what it's currently doing, and can be the best means of calculating how much it can increase as years pass by, as a means of a very stable and safe margin of worth towards their products and businesses. To the outlook you can project, it can continue to make more and more money. So then see if you're getting more money than what you're paying for. That's how you can see the sort of like the intrinsic value or worth of business. A basic area to analyze at first when you look at the financial statements goes like this. When you look at the income statement, the most important key thing to look at is the sales, revenue, and net income. For the balance sheet, the key area there is total cash, short-term investments, and cash equivalents. Now, companies can sometimes not have cash equivalents if there isn't any. When there's no cash equivalents, then you just want to see the total cash and short-term investments that they have, or at least the cash that they have. They don't have investments, which is very rare, but they usually do. In the liability section, the key area there is to find the short-term debt and current portion of long-term debt, right? Those added together into a total sum. The cash flow statement, on the other hand, the key area there is going to be the net operating cash flow and the free cash flow, okay? So when you look at these statements, look at them on annually, because not on quarterly, because we don't care, and we don't see the most accurate and stable figures from all their operations and investments through measures on how the company is making money solid per year and doing it in its current business. All right, so there's really a pattern that you always want to find when looking at these statements. All these items have to be consistently going up, or at least in overall, what I mean is that each 3 years, and it has to be higher than the last year, including the most recent year reported annually, or steadily going up for the past 5 years. Okay, so for sales or revenue, sales or revenue has to be rising. This is a perfect example graphically of what you want to look at in sales. You see this beautiful rise up. That's what you want to see. Although in overall, you just want to look at consistency to be going up. This is consistency in its sales and revenue. This is also consistency in its net income for anything, whether it's revenue, whether it's net income, whether it's cash, whether it's free cash flow or operating cash flow. Of course, not the debt. You don't want that to be for the debt. You want the debt to be reducing. Now, for total cash has to be rising or bigger than the short-term and long-term debt it has, which can also be reducing for the past 5 years, which is even better. Sometimes, though, it's fine that the debt is a little more than its cash. Just make sure then that by that case that the cash has been rising a lot more, in which the debt has been reducing. If the debt is higher than its cash, as long as the debt is not 2 times more than the amount of total cash they have for the past 5 years, still, you'd be fine. But if that's the case, that's a red flag, and that's probably not something that you want to get into. Now, of course, the best is if the company has much more cash than its debt and consistently going up when debt has been coming down, right? This is a great example. Cash is more than its debt. Sure, its cash has been reducing a little bit, but its debt is a lot more less than its cash. And the most importantly is that the cash has been recently going down, but the debt has been also recently going down. So that there isn't that the debt is going up relative to the amount of cash, or that the debt is higher than the cash. Then for operating cash flow or free cash flow, that has been consistently or overall going up in the past 5 years. This is an excellent example of the operating cash flow going up. When I see these figures, I see a money-making machine. This is literally a money-making machine. It's making money, more money by every single year that passes by. It's making more operating cash flow. It's giving more free cash flow. It's a money-making machine, right? And that's the way how you should invest. When you invest in a company, you should invest in it and see, okay, is this company going to make me more money than the other businesses I can possibly think of in a sure way, literally as a machine. It's a money-making machine. Okay, well, this is what you don't want to look for, because the net income hasn't been rising at all ever since 4 years ago. It's been like slightly lower and hasn't excelled as much. So that's not what you want to look for. What you want to look for is an overall rising of either the revenue, because this goes for revenue, net income, cash, or operating cash flow, or free cash flow, that you want to see these figures overall to be higher than what they were 5 to 4 years ago. That 1 year was, the other year went down. 1 year went higher than the other went down. The year later it went up higher than the fourth year or ever in the past 5 years. And then the next year maybe it goes down. But overall, by that explanation, you can think about it visually, it's really going up in total. All right. Now this is an example you want to look for. Look at its net income. You see how it's been overall going up. The net income went up here. It went down slightly, but the next one went higher than the one 2 years ago. The next year went higher than this one, and then the next year went down. But that doesn't matter, because overall it's been going up, despite the current year went down. It's been at a higher value. Now this example, this is not what you want to look for in the cash and debt. Look at its debt. It's like about more than 2 times of its size. And on top of that, this isn't much of a significant problem, because as the cash has been building up, so has the debt, right? That's not good. You'd ideally want it to be reducing, but at least you don't have, if the cash is going down, the debt isn't going up, right? I'm seeing in this that the cash has been going up along with the debt. So it's somewhat better in ways, but still with this debt, you don't want to look for this, because this amount of debt is beyond more bigger than its cash by double, right? And look at this. This is not what you want to look for. Look at its cash flow. Look at its operating cash flow. It's been going down for the past 5 years. It was at its highest over here, but then it went down on the next year. The next year went very down. The next year went higher than this one, but it's still beyond far compared to this one. Then on this year, it's lower than any of these. And net in total, it's been reducing in its cash flow. And same as said with its free cash flow, which is the blue. Same thing. It's been doing the same thing. It's been reducing. And it's net income, right? Net income is the green. You can see that there. It's not consistent. It's not a good business. In this case, this is what you want to look for. But the rest of these two, it's not. This is a better example, okay? Because look, in the past 4 years, the cash has been bigger than its debt. And even though the debt has been escalating, despite that though, on overall for the past 5 years, even though recently the debt has been rising compared to its cash, but only for the past 2 years. But if you look at the past 5 years, the cash has always been bigger than the debt. And the cash has been going higher along with the debt, when the debt has been a bit lower or maybe slightly the same, right? Look at this. This is a perfect example of what you want to look for the cash flow. Overall, it's been going up for the past 5 years. It was high here, it went down. The next year, it went up to the same level, and then the next year it went higher, right? This overall is showing you that the cash flow has been increasing as years pass by. And that's what you want to look for the past 5 years. You want to see that the cash flow or the net income or the cash or the free cash flow has been overall rising by years in those past 5 years in a higher value than what they were before. So that's what you want to look for. You want to also see additionally, now this is additionally, but I do tend to look at this quite often. You want to see additionally that the ROIC reduced by the WACC is the same or bigger to the WACC percentage. I actually spelled this wrong. WACC percentage. Look at the most recent reported year and make sure that the ROIC is at least 2 times bigger compared to the WACC, or that the ROIC minus the WACC is the same or higher to the WACC. So our ROIC stands for return on invested capital, and WACC is the weighted average cost of capital. What you want to look for here is that the amount of return that they're getting from the capital is 2 times from the amount of capital that they're investing in is 2 times bigger than the amount that they have to invest back, which is the cost of investment, right? So what that basically means is this: if the company has to invest $50 million in an investment, right, and the return that they're getting from the investment is $100 million, net in total there you have 50 million, right? So the return there net out of total is the same amount of the amount that they have to invest in the investment, right? That's what I basically mean. It's that it's 2 times bigger or at least the same to the capital, but net. This when I talk about this isn't nets. This is just talking about the return, right? The return has to be 2 times bigger than the capital it used to invest the money, right? It's like I don't know, you invest $100,000 and you get back $200,000, but you actually invested 100,000. So net in total, your return on investment there is the same amount towards the amount that you invested in. So that's what you want to look for. I look at this a lot more if the debt is higher than the cash. And I'll talk about that more specifically in a few lessons, because this tends to be more reliant depending on the type of products or services that they're selling to a type of customer. But also overall, if the debt has been, let's say, a bit bigger and I'm seeing that the cash has been reducing, but the debt has been rising. Another way that I still invest into that, as long as the debt isn't 2 times bigger. The other way that I use to invest into that business is that I see that the cash, or at least the debt that they're using, isn't of a problem. Why? Because of this. When a company usually gets debt, they use it as a terms of investment a lot of the times. It's important that their investments are making a higher return to the amount of cost that they have to put in the investment. Because you're going to know that, okay, that's not a bad debt. That's actually a pretty solid debt. And also the cash that they have. So the cash that they have are going to accumulate and generate more as time goes on, because they're making more money than what they have to put in to the investment.